Hey, everybody. Good afternoon, good evening, good morning, wherever you are. This is Doc Severson and Dave Lukas of 12 Minute Trading. Today is Thursday, the 13th of October in 2022. Whether you're joining us live here today, live stream, or are you watching this through a replay, welcome aboard. Do us a favor, if you could, go ahead and hit the thumbs up button just to let the world know that you are watching 12 Minute Trading. And if you have not seen us before, please do us a favor and subscribe to our channel so more people know about what's going on. And also, you're going to be informed when we do start streaming. So hopefully we are going to keep things short, tight, and concise with you. And I'll tell you what we see today. Today was a huge day in the markets, and we're going to unpack that as best we can. What are you thinking out there, Dave? What do you see from today's movement?
Today was one of the most incredible reversals I think I've seen in a number of years. Conventional wisdom, right? If CPI came in higher, especially the core CPI, we're going to fall off the cliff, right? 2008 analogs in play, all that stuff, right? And usually when everybody is on one side of a trade, we go the opposite. But it was I think 6 out of the last 8 CPI prints we've gone down, and so it started out that way. It started out like everybody expected, and then it seemed like that 10 o'clock hour, somebody hit the buy button and just drove this thing all the way back up. It's almost like the algos were pre-programmed for that 2020 low there, that 2020 level about where things fell off, and they hit it and they just kept going, and the shorts had to cover. And I think that's what kind of drove it up. So the question will be now is, can it continue?
Absolutely. Absolutely. So this morning we were actually up. I think we were up something like 20 or 30 handles on the S&P. So we had a pre-market gap to the upside right before the report.
That was because of Britain.
That was because of Britain.
Yeah, Britain.
And immediately right after the report that was one of the fastest dumps that I've seen in a long time. And so we actually, from peak to trough, 150 handles to the downside before the price found its footing. I'm going to share with you guys a chart over here. So Dave, you won't be able to see this, but I think the folks on the stream will be able to see this. I'm looking at the S&P 500 futures right now. And if you look at this, this was the last CPI print that we had, which was in mid-September. And that was a real surprise because people thought at that point that we were going to see the CPI drop and maybe go negative. Everybody was really optimistic about it being negative, and it was a huge surprise. Everybody was on the wrong side of the boat when the wind shifted and knocked them all overboard, and we've been dealing with that for some time now. A couple of bounces up, and what do we have here? 1, 2, 3, 4, 5, 6 straight days to the downside. And there was something I saw in Sentiment Trader this morning that this was the worst for new lows of the year and down, 9, 10 months of the year. This was the worst sell-off since October 2008. And so here we are with similar conditions, and we're dropping like a stone down well below today's expected move. And then boom, like you said, that we saw like a late morning surge. And I think the way I've heard this explained is that, hey, this is peak inflation. When everybody sees the same thing, let's take the opposite side because the shorts are coming out of the woodwork right now. Everybody is short. And in fact, all the major commercial hedge funds are nearly all dead short right now. And so somebody catching them on the wrong side can make a nice trade. Now, this is just another lower high. So we can go over to the intraday chart here just for a second, and you can see how we traded.
Another thing, Doc, while you're going to that too, it kind of occurred to me is, we've gone through a number of these inflation prints now where everybody's like, oh, inflation's going to come down. Inflation's going to come down. And there were some things in this report that started to come down, some elements and stuff that started to come down, which kind of maybe fits your theory there of maybe peak inflation. But the other thing I'm thinking too is we're getting to the fourth quarter, right? In the fourth quarter, we always know September and October is usually, rough times for the market. And you typically get your rally, your Santa Claus rally at the end of the year, and that sort of thing. But part of me is just wondering, you've got all this money coming in the markets every week. You got all these fund managers and everybody else that are sitting on capital they have to deploy, and they're sitting there going, you know what, maybe this is just the new normal. And that's just what, let's get to work. And I think maybe there's some of that going on too, to where it's like, all right, look, inflation's going to be up. We know the Fed's going to go up another 100 basis points or 150 basis points. They're going to get rates in the 4.5 to 5% range, which, by the way, is still not enough to even keep up with where inflation is. And the markets are going to return better. So they're like, you know what, let's get in and start, getting in at these low prices and start taking, getting some bargains and running things up. Part of me thinks that might be going on too.
Oh, absolutely. I'm going to go back to a chart really quick here. This is our triple pane fractal chart that we typically look at. And the one thing I'd like to point out is this weekly swing to the downside is very similar to what we saw from April down to June. It's about the same in terms of just amplitude to the downside. We did hit the 50% fib almost to the tick here for the swing all the way from the pandemic lows all the way to the highs. So we hit that 50% fib to the tick today. So that's very important. But also what's going to happen here is as we get into next week, the week after that, this very, very linear move to the downside is going to catch up with us. And I think what we're starting to see is the market anticipating that. It's running out of gas. It's running out of sellers, right? The sellers no longer have the strong hand because there's so many of them. It's a very crowded trade, right? So it's just like somebody being in a theater, yelling fire, and there's only one exit to this. So from a technical perspective, as well as maybe a fundamental perspective, we could see maybe the case for a little bit of a bounce here over the next month or so. Maybe it's just going to build a bear flag, and the character of that bounce will tell us everything about it. So it's a very choppy bounce that works up to the upside, kind of like what happened in, I hate to bring this up, in the 2008 analog, but August of 2008 was a bear flag. It was a very choppy little rally that really had a very difficult time getting going. And that sort of preceded the real dump into late September and October. So we'll see what the character is of this. And right now, price action is still making lower highs and lower lows. If that changes, we will watch and report and change our trading appropriately because we'll be in a different type of character. There's
one more piece to this. One thing, I like to look at the big picture and the macro side, but also zoom out on these markets and stuff. And there's something I shared the other day with students. I did a private live session for students, and I think it's really important to share with those here. Maybe we can end on that. I'm going to share a screen if that's okay.
Yeah, do it.
So this is a 20-year monthly chart on the S&P. Okay. So this is 20 years going back now. So that means we've got pre-2008 in here and post, right? And so one of the things that I think is really important that I've been watching is this down here is our fractal energy line. So this tells us how much energy is in a chart to trend. Now, it doesn't tell us which way it's going to go, but it tells us if a chart is ready to trend or not. And so when we're typically up in this zone up here in the 50 to 60 zone, we're pretty charged up and ready to go. When we're down here in the 30, 25 zone, we're pretty exhausted. So whatever trend we've done is probably over, right? And so one of the things that I've noticed, if you look at, these are the Bollinger Bands, the standard Bollinger Bands. And so here's 2008. And so typically once you start falling through the bands, they'll widen and expand, but eventually you're going to catch up and get snapped back into the bands, right? I always say, kind of think of them like a ropes on a boxing ring, right? The boxer hits against them, but gets thrown back in, right? They bend, they don't break. And one of the things you'll notice when we look at these levels, you'll get to these levels where we're fully charged, right? And if you're near the upper Bollinger Band, you're typically going to go the other way, right? Versus when you're exhausted and you're on the lower Bollinger Band, you're going to go the opposite direction, right? That's, markets will run as far as they can in one direction, turn around and run as far as they can in the other. And so if you notice all these times that we're at these levels and we head down, even if it's a little bit or a lot, from a monthly chart perspective, we're at a high or near the upper Bollinger Band, and we bleed that energy down, right? We are now at a low on the Bollinger Band, right? And we're fully charged. And where did we go? We went up. So here we are on the lower Bollinger Band, sitting here fully charged. We've got October positive green. The last 2 weeks actually have been green. I know last week didn't feel like it, but the S&P actually ended up like 30 points. And so you've got this starting to roll over. And the question is does this become the beginning of that trend back up again? Hard right edge, we don't know. But every time we get down in here, we typically go back the other way. So what we would have to see is something much, much worse than this, because when these go, this happens over the course of 8, 10, 12 months. It's not a weekly thing. It's not a monthly thing. It happens over a lot of months. So that would mean if we're going to go down from here, we're going down to like low 2000s on this thing. That's how much energy is in here to do it over the course of a year. So that would break all patterns for the last 20 years. So are we at a point where this thing is turning around and getting ready to head back the other way? And we're going to grind up higher from here into 2023 and beyond, because the Fed's going to start to slow down in early 2023 by their own messaging. So that's something interesting to watch, something to keep on top of, because it would definitely break 20 years of history if we just crash down further from here over the next year.
Something else to keep in mind, too, is just more of on a fundamental and political landscape is the potentially the election creating more gridlock. As we talked about this last week, more gridlock taking the market, which is good for the market. Gridlock is always good for the market because nothing gets done. And so the market is on its own. It's left to its own devices. It doesn't have to worry about any more event risk coming in from Congress. So we'll see if that is the case for this right now. If the market continues to go lower from here, it is almost a sure thing that we're going to have turnover come early November.
Yeah. So it's, and today could be a one-day wonder. We'll see what happens. We've seen this where I've seen it on Powell days where he speaks and the market, the S&P goes up 80 handles and then gives it all back the next day. So if we hold this, tomorrow and into next week and continue, we started to actually, we were at one of the highest points on the daily chart for its energy, and that started to go today. It's the highest point in a year for the energy. And so today's move was the beginning of the release of daily energy. If that follows on tomorrow and continues into next week, we know we've got kind of we've got a decent reversal, at least for the next few weeks, and probably maybe into middle of November.
Right. So watch these levels. Watch 3,800 on the S&P to the upside. From there, watch 3,900. That's the next level of resistance. If we get above that, we're going to be above the 50-day moving average, and then the next challenge will be the 200, which could be very important. If you look back on all the bear markets we've had over the last, say, 50 years, the 200-day moving average has been a great delineator in terms of when the bull versus bear and when the bear is kind of over. So we'll watch that carefully as well, too. So we're optimistic about this, but at the same time, we're also realistic about this, that the trend is still to the downside right now. So
you can't trade the market you want. You got to trade the market you have. So whatever it throws at us, we'll continue to trade it and create income off of it. But, this was, maybe the start of something pretty big back the other way today. Yeah.
Well, thanks again, everybody, for joining us here at 12-Minute Trading in our live session. We plan on doing these every week, so please join us. Don't forget to subscribe. Hit the notification bell so you are notified when we do start streaming. Normally, we are going to be doing these on Monday afternoons, so a little bit of a change in the schedule this week.
Couldn't help ourselves today,
right,
yeah.
Right. So thanks, everybody. Thanks for joining us, and we'll see you next week. Thanks. Goodbye.